Disclaimer: this video is for informational and educational purposes only. Nothing in this video constitutes financial, investment, tax, or legal advice. All opinions expressed are personal views only. Past performance is not indicative of future results. Please consult a SEBI-registered financial advisor before making any investment decisions. The creator is not responsible for any financial losses incurred based on information presented in this video. The RBI just held rates steady again, 6.5%. For the seventh time, most of you are still clueless. You're letting inflation eat your savings. You're missing opportunities. You're making the same mistakes I've seen for 25 years. This isn't some abstract economic news. This is your money, your hard-earned rupees. When the RBI keeps rates high, it makes loans expensive. But it also means your fixed deposits might finally offer a decent return. Yet most people just sit there. They don't adjust. They don't think. Meanwhile, inflation is still a silent thief. Your money buys less. Your financial goals get pushed further away. You're stuck, watching your wealth erode because you can't be bothered to understand what's happening. This costs you real money every single day. So, the Reserve Bank of India. They control the cost of money. The main tool, the repo rate, that's the rate banks borrow from RBI. Keep it high, borrowing gets costly. Economy cools down, keep it low, borrowing is cheap. Economy heats up. They've held it at 6.5% for a while now. Why? They're trying to balance growth and inflation. They think India will grow 7% this year. Good. But they also expect inflation around 4.5%. Still a bit high for my liking, but manageable. The market, though, it's already pricing this in. Nifty 50 went up 1.24% in April. Metal stocks, they loved it, up over 11%. Small and mid caps, they're still outperforming. Nifty small cap 100 gained 11.4%. People are chasing returns. They see the rate staying put and think stocks are the way, maybe. But it's not that simple. What does this 6.5% repo rate actually mean for you? First, your loans. Home loans, car loans, personal loans. They're not getting cheaper anytime soon. If you have floating rate loans, expect your EMIs to stay put, or maybe inch up if the RBI changes its mind later. Don't expect a sudden drop. That's the bad news. The good news, fixed deposits. Banks have to offer better interest rates when the repo rate is high. So your FD might be earning you a respectable 7% or even 8%. That's decent, especially if you're risk-averse. But are you putting your money in FDs? Or is it just sitting in your savings account earning 3–4%? That's a mistake. It's like leaving money on the table. Then there's equity. When rates are stable, it signals some predictability. Investors get comfortable. They might put more money into stocks. This is why you saw the market moving. But remember, 6.5% is still not a low rate. It's a stable rate. It means inflation is still a concern. You can't just blindly buy stocks. You need to be selective. Small and mid caps are volatile. They can give big returns, yes, but they can also crash. Are you prepared for that? Most of you aren't. Stop guessing. Start acting. Here's what you do right now. 1. Review your loans. If you have high-interest debt, explore options to prepay or refinance if possible. Don't be lazy. 2. Check your fixed deposits. Are you getting a competitive rate? If not, move your money. Don't let banks take you for a ride. 3. Rebalance your portfolio. If you're heavy on volatile stocks, consider moving some to safer assets, or at least ensure your overall allocation makes sense for your age and risk tolerance. Young professionals, you can afford some risk. Older folks, be more cautious. 4. Use a good platform to track your investments, something that shows you your returns, your asset allocation, and potential risks. Don't rely on spreadsheets and memory. I personally use D-Money for tracking everything. It's simple and gives a clear picture. You can also check out Growa for investing. They make it easy to start. Just don't be a fool with your money. 5. Keep an eye on inflation. Don't just look at the repo rate. Understand what it means for prices. If your salary isn't keeping pace, you're losing ground. The RBI isn't going to manage your money for you. They're setting the stage. You have to play your part. Stop making excuses, make smart moves, or keep losing. Your choice. Subscribe for more blunt advice. You need it.